My name is James Bremis, and as Angel mentioned, I'm joined by Ryan Petty. And today we're going to talk about some things that you should consider from a financial planning standpoint for 2022 as we invest alongside inflation. If you've ever been to Mexico, you've probably heard about the famous cliff divers in Acapulco. Cliff diving there is very dangerous and it requires a lot of skill because it's about a 134-foot dive from the cliffs into a narrow, rocky inlet where the waves swell to a depth of only 14 feet, and it only lasts for about 5 seconds. But these divers know from experience when to dive in. You can see water at the bottom of the cliff rise and fall with the currents. A first-time cliff diver, though, might jump when they see the water at its crest. But by the time they land, the tide's out and the water's too shallow. On the other hand, these experienced Acapulco cliff divers know to wait until the tide is out and they can see the rocks, and that's when they dive in. By the time they land, the tide is in and the water's at its crest. And that's a little like investing, right? Having patience and discipline is paramount. Some people buy at high tide, but experienced investors wait until they see the rocks. And that sets the stage for what we're going to be talking about today. In years like this, it's important not to overreact, but strongly consider the challenges and opportunities this market environment's presented. So we're going to talk about a few of the key factors that are influencing our portfolio and planning decisions this year. Some planning ideas to consider before year end. And then we'll also address some potential pitfalls you might experience along the way. And with that, I'm going to hand it over to Ryan. So, Ryan, what's really driving the angst in the markets this year?
Yeah, thanks, James. And as was previously mentioned, my name is Ryan Petty. I'm also a financial planner here at Sentinel. With the landscape of 2022, economic uncertainty was extremely high in the first half of 2022 and still remains high today. There are multiple factors at play when describing this. One of them is the geopolitical turmoil with the Russia-Ukraine situation. The impact of this has been driving up energy prices and further fueling inflation. Inflation has been a huge problem this year. It's visible in all of our lives, whether you notice it at the gas pump, in the grocery store, or going out to eat. To fight this high inflation, the Federal Reserve's raising interest rates as well to, bring down inflation and cool it down. But I'll talk a little bit more about those as we get further into the presentation. Here we have inflation. This graph is showing inflation over the last decade. Inflation is simply the increase in the cost of goods and services over time. On average, the annual inflation rate is about 2 to 3% historically. But as you can see in this graph, 2022, we're facing inflation that's over 8%. It's very important to keep this in mind and think about this as you save more for your future and your retirement. Pay attention to your budgeting and other things that you can manage when thinking about you and your family's financial situation. Interest rates. This graph is showing the 10-year Treasury rate over the last decade. The 10-year Treasury rate is the benchmark used to decide mortgage rates across the country and is the most liquid and widely traded bond in the world. Bonds are particularly sensitive to interest rate changes. When the Fed increases rates, the market prices of these existing bonds immediately decline. That's because the new bonds will soon be coming to the market, offering investors higher interest rate payments. The Federal Reserve's job is to manage monetary policy for the United States, which means controlling the money supply. So how much money is in circulation? The Fed in recent months has raised these interest rates to fight the record high inflation that we're facing. Higher interest rates make it more expensive to borrow money and pushes people to save more and postpone certain purchases and projects. This then reduces the amount of money out there in circulation, which hopefully will cool down inflation. As I mentioned earlier, and we're going to continue to reiterate throughout the presentation, it's very important to continue to save for your future and your retirement. So here are the annual limits for 2022. A person under the age of 50 can contribute up to $20,500 into their 401k or 403b, while someone over 50 can contribute an extra $6,500 as a catch-up contribution, which brings them up to $27,000 for a limit of 2022. In an IRA, a person under the age of 50 can contribute $6,000, while a person over the age of 50 can contribute an extra $1,000 of catch-up contributions, bringing them to $7,000 for annual limits in 2022. There are cost of living adjustments on these retirement plans and what you can contribute. The IRS normally comes out with the following year's annual limits in November. So keep an eye out for potential increases going forward in 2023 for these annual limits in this high inflation environment that we're facing. It's also worth noting that there are cost of living adjustments to Social Security checks as well. Going from 2021 to 2022, Social Security increased by 5.9%, which is rather high. For 2023, it's expected, it hasn't been released yet, but it's expected to increase by close to 10%, which is a very substantial increase going forward.
Thanks, Ryan. And with that, I think it's pretty clear when you look at your accounts and you look at everything that Ryan just discussed, there's been a lot of market volatility so far in 2022. But volatility creates opportunities, right? So we talk about those annual limits. One way to take advantage of these opportunities is definitely to continue contributing to your different savings accounts, whether it's retirement plans, your HSA accounts, or personal brokerage accounts. Definitely continue to take advantage of these opportunities and continue to invest. But in addition to that, we also wanted to touch on some key planning techniques that you should consider taking advantage of before year end, given all of the market volatility that we've seen. So first off is rebalancing. Anytime you have significant dislocation in the markets like we've seen, your current allocations could be significantly different from the original targets that you set. By rebalancing, you put it to practice the old investing adage, buy low and sell high. You effectively allocate more money to the positions that are currently discounted by trimming from the positions that have done comparatively well, and you might have potential gains. This might be helpful to your overall financial plan if you're a long-term investor who wants to stay in the market, but is diligent about monitoring your portfolio. The good thing is if you own target date funds or a risk-based portfolio in your retirement plan, you're already taking advantage of this. The portfolio manager maintains a target risk tolerance, and when there's fluctuations in the market and you become overly aggressive or conservative as a result, they rebalance you to bring you back to your stated risk exposure. Next is tax loss harvesting. So over the last few years, investors have generated significant capital gains after strong performance years like 2020 and 2021. In turn, they also created high potential tax liabilities outside of their retirement accounts. If you have positions that are down this year, realizing those losses could potentially offset any gains that you've generated over the last few years if you decide to realize those as well. This works well if you want to access part of your portfolio in the near future, giving you a tax-efficient way to free up some cash for new investment opportunities or to supplement your current income. Every couple of years, I feel like Roth conversions come up from time to time. And it's usually, a way for people to take advantage of whatever situation that you're typically seeing. The hard part is finding a good time to really execute them. Usually, the time that they come up is when there's a political shift underway and people want to hedge the risk of higher tax rates. Other times, it's in years like this. If you have cash on the sideline and positions in the market, this is a good option, especially if you're uncertain about your prospects in the market over the next few months. Effectively, you'd convert your positions in your pre-tax account in kind to a Roth account, taking advantage of the lower tax bill you might have now because of the lower prices you have in your positions. Your cash on hand could be put to work without taking on volatility by paying this year's tax bill on the conversion, and that set you up for potential tax-free future growth. If you're looking at Roth conversions, you can certainly do them in IRAs if you meet the requirements that we just discussed. If you're looking at doing them in your 401k plans, it's something to make sure that your company actually allows you to do. And Ryan talked a little bit about inflation in the last couple of slides. With the price of goods increasing quicker than wages, budgeting becomes even more important. Your grocery list might not have changed much over the last year, but the price tag certainly did. And it's important to revisit your budget to make sure you're still able to put money towards different savings goals. Years like this are times when you want to make sure you continue saving and buying into the markets. I suggest setting an annual budget around New Year's, but then throughout the year, I track my progress on a monthly basis. So taking a look at all of your different income sources, whether that's the payroll income, rental income, interest and dividends from different investments, taking a look at what you anticipate your expenses to be, having your fixed expenses, so basic living expenses like house and shelter, food, all of those things, as well as discretionary expenses. And at the end, you'll either come up with a surplus where you'll be able to save for different savings goals, whether that's retirement or other short-term savings goals. Or you might have a deficit, in which case you'll have to revisit what your expenses actually are and try to figure out ways to increase what you're actually saving. I usually try to set an annual budget around New Year's with my fiance. Then throughout the year, we track our progress on a monthly basis. With some spending categories like groceries, for example, you might be spending more than you thought. But by tracking your spending regularly, you can scale back on certain discretionary expenses, like traveling as an example, to make sure you don't have to sacrifice saving towards your financial goals. When we work with private clients, I find budgeting is really the cornerstone of any financial plan. And when you have a plan, it allows you to clarify a few things. You know what your goals are, you have a plan to reach those goals, and you know what steps you need to take so you can track your progress. This helps to take the emotion out of investing. And when you do that, you know what investments will get you there. So instead of trying to swing for the fences with returns, you choose the investments that meet your goals. And with that, I wanted to share some considerations when choosing your investments. The two biggest things that we try to focus on, or how I measure financial success, is in your ability to answer two key questions. When it comes to the first question, will I make it? We found that most people don't have any sense of whether or not they're going to make it to their dreams, goals, and aspirations. So that's where we start. We go through a deep discovery process where we help you define everything you're trying to accomplish in your financial life with a high degree of specificity. We then take everything you're currently doing financially, lay that on top of your goals, and tell you definitively whether you are, in fact, going to make it. If the answer is yes, we pat you on the back and say, congratulations, you're well on your way. If the answer is no, which we find oftentimes it is, we surface the shortfalls and challenges and give you rational solutions to get you back on track. Once we answer question number one, we move to question number two. Do I have any financial blind spots? Or is there anything I overlooked that could do myself, my family, or my business harm? Because there's nothing sadder in life than marching off towards all of your dreams, goals, and aspirations, only to get blindsided by something you didn't anticipate. So we take a 360-degree look at you from a financial perspective, looking for a risk exposure you haven't uncovered. And once again, if we find something, we're going to surface the issue and give you rational solutions to close that risk exposure. For most people, the biggest threat to your portfolio is going to be emotion. I often hear people say that they'll move to cash when the market's underperforming and get back in once things stabilize. My first response is, okay, you have an exit strategy, but how will you decide when to get back in? The hardest part is figuring out when to put the money back to work. And oftentimes, people miss the boat on the rebound. The best days in the stock market tend to cluster together, and they're easily missed. So for that reason, you don't want to time the market. At Sentinel, we've been very diligent in monitoring cyber attacks and increasing the security of your accounts with us. Cyber attacks have definitely picked up in frequency and complexity over the last 12 to 18 months. So it's really important to revisit some of these important tips with regards to cybersecurity. The best protection really relies on you as the consumer. You want to make sure that you have a strong username and password for your financial accounts. You also want to make sure you update these credentials periodically. Sentinel also utilizes several additional layers of cybersecurity. One is multi-factor authentication, where we send a code to your email or your phone to verify when you try to access your account. And in addition, there's several other checks that are utilized for accessing money. On corporate retirement accounts, you're required to complete an identity verification quiz. Then your plan sponsor approves the distribution. For private clients, your financial planner is your added layer of protection. So in the beginning of today's seminar, we talked about how the current market environment can create potential pitfalls. So we want to close out with things that you want to avoid. If you've taken the time to plan out your future and your long-term goals, 1 year of underperformance shouldn't derail that. So keep today's losses in perspective. It's important to focus on controlling your controllables. When you don't have a plan in place and you're fraught with emotion, you're more likely to react to the current market environment. And when you do this, you're more likely to make decisions that could have adverse consequences. On the other hand, when you have a plan in place that you can trust, the emotion takes a back seat, allowing you to act with more clarity and to adapt your plan to variables you've likely already considered, like a market pullback. And with that clarity, you realize that markets eventually recover.
Yeah, and you also don't want to only focus on the future. While saving and investing for retirement in your future is very important, and we stress the importance of that, you don't want to neglect short-term and medium-term goals with your financial planning picture. The first step to this you want to have a good strategy on budgeting and debt. One rule of thumb is you don't want to be spending more than what you're taking home, whether that's weekly, biweekly, monthly, however you get paid. You always want to spend less than what you're earning. Step two, we really recommend everyone to have an emergency nest egg. We recommend 3 to 6 months worth of fixed and variable expenses. We recommend having this very liquid and available. If, God forbid, anything were to happen, lose your job, you have this to fall back on. And finally, with insurance coverage, you want to make sure that you're protected. Life throws curveballs. Life certainly isn't linear. Things happen. You want to make sure that you have adequate insurance coverage to protect you and your family financially, and just if anything were to happen, God forbid.
This year's been tough to stomach. And seeing major equity markets enter bear market territory has been really tough to handle. But it's important to remember that when you look back, US equities have always recovered. Any investor who's lived through a bear market knows how unpleasant it can be. History shows, however, that US equities have always recovered and that bull markets have created far more wealth over time than bear markets have taken away. Bull markets have outlasted bear markets for more than 75 years. The most recent bear market that we've experienced before this year began in mid-February of 2020 and ended in early April of 2020. The S&P 500 fell as much as 34% before it recovered and entered positive territory before year end.
Don't wait for assistance. Don't hesitate to reach out to your dedicated financial planner, financial wellness educator with anything that you have, just to see if you're on track or any questions that you might have. We're all here, happy to help. You can also check out various resources that are offered on our website, sentinelgroup.com, or you can log into your retirement account on our website and go into your account, and you can play around with the tools and education tab. We have a lot of great resources in there for something as small as buying or leasing a car to something as big as buying a home and stuff like that. So don't hesitate to reach out to us. We're happy to help, and also don't be afraid to go on the website and play around with some things and look at the resources that we offer.
You don't need to look too far for help. Sentinel's private client group is a seasoned team of financial planners who are not only able to manage your portfolio, but take into account other factors as well. Working with a financial planner not only helps you think about which investments you should be in, but how to be more efficient from a tax standpoint with your investments, how to make sure your estate will go to the people you want it to, when you want it to, in the most efficient way possible, and we can help you monitor your assets in retirement to make sure you don't outlive your money. And we'll also work to uncover financial blind spots you might have overlooked and propose rational solutions to close those risk exposures. So if you have any questions about any of the strategies that we discussed here today and how to put those into practice in your personal financial plan, by all means, as Ryan mentioned, please contact your Sentinel financial planner. You can schedule time with them directly through their links on the Sentinel website. Or if you have any additional questions that you'd rather address with us, please feel free to contact either myself or Ryan today. So with that, I think we'll go ahead and open it up for questions.
Dan, there's a couple of questions in the chat, the Q&A section. I think the first one would relate to the Roth conversions that you were speaking to throughout the presentation.
Yep. So this first question. So many financial counselors are recommending to convert traditional IRAs to Roth IRAs. What do you think about instead converting traditional IRA to Roth, but rather the strategy of buying permanent cash value life insurance? When it comes to the cash value life insurance piece, cash value life insurance can have a place in anybody's financial plan. But usually for me, it's kind of an afterthought, at least for cash value life insurance, because of a couple of reasons. Cash value life insurance is very expensive, one. And when you buy cash value life insurance, you're really limiting the flexibility that you have with that money, right? So I'd rather see you exhaust the other tax advantaged accounts that are available to you first and make sure you're contributing to those first. So normally if you're maxing out your corporate retirement plan, your personal retirement account, if you're able to contribute to that, any sort of HSA monies, I'd rather see you contribute to those first because you have more flexibility with those accounts. Then the life insurance is the next option that I would look to try to make sure that you're taking advantage of that. And even with cash value life insurance, I mentioned the cost of it. We would never recommend someone buy only a cash value life insurance policy, right? Given the cost that's tied to it. But it can certainly supplement any other life insurance policies you have and factor into your retirement income plan as well.
Yeah, and there's another question. It reads, maybe unrelated, but if an individual chooses to collect their Social Security benefits, say at age 64 versus 66 in 8 months, is there a limit one can earn while working and simultaneously collecting? While there's no limit, if you collect Social Security before full retirement age, you're going to receive reduced benefits. If you wait until full retirement age, you'll receive a full benefit. And if you even wait until the 3 years after the full retirement age, say full retirement age is 67 for you, and you don't collect until 70, every year after your full retirement age that you don't collect, you'll see an 8% increase in your Social Security check in delaying it. But that's something that we can certainly help people with Social Security planning, when to take it, when to get the correct benefit that might fit your financial plan and profile here at Sentinel.
Next question. So is there any discussion regarding the possible waiver of 2022 RMDs in view of the current inflation and concurrent downturns in the market from the measurement date of the preceding December 31st? No, I haven't heard of any discussions regarding that suspension. You would think it would make sense, right? If you have a down year in the markets, you'd rather take an RMD off of, you wouldn't want to take the RMD off of that higher balance that you had on 12/31. But no, I haven't heard any discussions of taking those RMDs and suspending those. Next question. I have a Roth and I chose the investments as I do not follow the market. I heard about social index and ESG. Could I add that, or would that be a change in what I invest in generally? So ESG, for those who don't know, is environmental, social, and governance, and it's way to be socially conscious with your investments. ESG has definitely picked up over the last few years, and it's something that I think a lot more investors are asking for. But as with all things in the financial services industry, I feel like the financial services industry has been really slow to adapt to the needs of clients. So with ESG, there's definitely good options out there that are available, but I think it's really important, first off, to really decide what kind of socially conscious investing you want to go with, or what's really important, what your personal values are, and kind of come up with a personal investment policy statement, if you will. And that's going to allow you to figure out and kind of evaluate investments that meet that stated criteria. Because ESG can mean a lot of different things depending on which company you decide to invest in and which standards they use to measure those investments. So that would be the first thing. If you have a company retirement plan, typically it's going to be a little harder to implement ESG investments because we have a whole different set of regulations we have to meet with corporate retirement plans. But it is possible to have those in your company's retirement plan as well. If you want to invest via ESG in an IRA or like a personal brokerage account, it's a little easier to do that there too, because you can really tailor the investment specifically to your situation. But that's a great question. If you want to discuss that more in detail, please feel free to reach out to us or your Sentinel financial planner.
I see another question. I have a 401k still with my previous employer. Do you recommend rolling it to my current 401k, an IRA, or something else? So with your previous 401ks, you do have a couple options. Some don't apply to people's situations. But the two main ones that you have, if you're still working, you can roll it into your current 401k, or you could move it to an IRA. It's all just dependent on personal preference. Some people like to have it all consolidated in one place. Other people like to, have it separate, but at the same time, you want to make sure that your investments are aligned accordingly and consistent with where you are in your working career and your risk tolerance. So that's personal preference. You can't go wrong either way, but it's up to you and what you're looking to ultimately have. And if that's worth a conversation, it's definitely worth reaching out to a financial planner, wellness educator, to go over your situation and how it fits into your profile.
Next question. What do you think of the Treasury inflation protected securities, or in addition to that, Series I savings bonds? It's a good question. So, Treasury inflation protected securities, some of those Series I savings bonds, if you're looking for some inflation protection, those are definitely options. I think with inflation, the way how quickly it ticked up, with how quickly interest rates ticked up, they didn't provide the amount of security that people would have expected, given the current environment. But, for anybody, I think it really depends on what you're looking for. As if you're looking to access your monies, relatively soon, if you're looking for a way to protect money for near-term distributions or near-term financial needs, you really want to keep duration low primarily, first and foremost. I think that's the most important thing. We've done that with a lot of our private client portfolios, using, some different strategies, but that's going to be the most important thing with your investment portfolios. But when you're deciding how to invest, usually my first question is going to be, what are you investing for, right? Is it something that you're going to need 5 to 10 years from now? Is it something you're going to need, within the next 12 to 18 months? That's really going to determine how you're going to be invested. If you have that 5 years or longer time horizon, that allows you to be a little bit more aggressive because, on average, a full market cycle from trough to peak is typically, somewhere around that 5 to 7 year range. So you can afford to be in stocks in that case. If you're looking at a time horizon that's shorter than that, you have to be a little bit more conservative to protect the principal. But that's a good question. If you're really concerned about inflation, there's all sorts of different inflation hedges that you can take advantage of. Some of the more common ones would be tips, commodities, probably the best performing sector of the market. The only sector of the market that's up year to date for the majority of the year is energy, right? And oil. You could also look at things like real estate. These are all pretty common inflation hedges, but to figure out which one makes the most sense for you, again, definitely recommend sitting down with your Sentinel financial planner.
Next question. I'm 73, moved money in my 401k to cash account, did not have a lot. When should I move it back into the market? So this is, going on with James, he was talking about with people moving to cash, and it's very hard to time the market, and everyone wants to buy in at the bottom. But essentially, we want to see people, get back into the market, especially being at 73. You want to make sure that you're preserving the account as long as possible, focusing on asset preservation, and most importantly, just keeping pace with inflation. Inflation's super high right now, and that alone can kind of reduce the value of what you have in there. There's not necessarily a time that I can say that look into my crystal ball and say this is when you should do it. You can start doing it now, and you can take a strategy of dollar cost averaging where you don't put the whole amount in right away. You just look at 10 to 12 months and divide what you have by 10 to 12 months, and you can deposit that money back into the market over that course of time, and you'll buy in at different prices. And what that does, with the market right now, it's very volatile. That just will reduce overall volatility as you're buying in at different prices over the course of 10 to 12 months.
So Ryan, you brought up dollar cost averaging. If anybody's contributing to their 401k or their HSA, you're dollar cost averaging as we speak, right? Because every time you contribute to your retirement plan, it gets invested every 2 weeks. So whatever the prevailing prices are in the market, those are the prices that you're paying when you buy those different investments. So we talked a little bit before, Ryan talked about the contribution limits. That's why it's important to continue to contribute during these times when there's a lot of volatility, because you're going to lower the average price that you pay per investment by continuing to contribute. So really good point. How long does it take to make a Roth conversion from a 401k? What's the tax difference? So we talked about Roth conversions a little bit before. With 401k, it's just because they're corporate retirement plans are institutional. Anytime you hear the word institutional, I feel like it's an exaggerated timeline than if you're doing it in a personal account. But really, what you're doing with the Roth conversion when that happens, or when you decide to do one, is you're taking the existing assets in your account, you're basically reclassifying them to after tax, those pre-tax assets, and you're reclassifying them to after tax. So basically what you're doing in that situation is you're realizing those assets as income in the year in which you make that conversion. So your tax difference that you mentioned there in that question, the taxes that you're going to pay are going to be whatever income tax bracket that you fall into for that year. So that's one of the main reasons why you don't see Roth conversions too often, because you have to realize the taxes at the time at which you make the conversion. And in addition to that, you have to have the cash on hand outside of the account in which you're making the conversion, so that you don't create a distribution for yourself. Those are two things that kind of make them unpopular. But if you do have those two things aren't concerns for you, if you do have the cash on hand to pay the taxes, you don't mind paying the income because you're not in that high of a tax bracket already, Roth conversions can make a lot of sense for folks. And as far as the timeline, it's kind of hard to say, but depending on everything and all the different pieces that are working together, typically you can make it happen within 7 to 10 business days, I would think. I feel like that's a fair timeline.
Yeah, and to kind of snowball off that, the final question I see in there: can you move money from your IRA to a Roth annually without penalty? If you're going from one retirement plan to another retirement plan, qualified plan, there's not going to be any penalty. Because there's no taxable event, there's no distribution. But as James mentioned, going from an IRA with pre-tax dollars to move it to a Roth, it's going to take, you're going to have to pay the taxes on that. And that, like James said, you'll need to have the cash on hand to do so. But you don't have to do it all at once. You can spread it out over the course of time so you feel a less of a tax burden.
Next question: can you move money from your IRA to a Roth annually without penalty? Yeah, so there's no penalty to convert to Roth, right? As we mentioned, the only thing that you're going to be responsible for is the income taxes that are going to be due when you convert from a pre-tax IRA to a Roth IRA. So there's no limit on how much you can convert, but the main thing you really want to make sure of is that you're not pushing yourself into too high of an income tax bracket when you do decide to convert from pre-tax to Roth. That's going to be the main consideration. So, this year you definitely want to consider it just because of how far the market's fallen. And if you are in investments that are still negative this year, that just kind of creates some more impetus for you to review this and see if it makes sense for you. But let's say you want to convert a specific amount in a given year, but it's going to push you into a higher tax bracket. You can split your Roth conversion over multiple years. So it's definitely a unique strategy to kind of take a look at. But it really just is something that you want to make sure that you think out all the consequences and discuss those with your financial planner.
Know what is a Roth and what is on the 401k. It is not broken down. So if your employer provides this, you'll have the 401k, and there'll be two features that you can contribute to in it. You can contribute pre-tax dollars, and you can contribute Roth dollars. They're basically just different buckets that the money will go into, and whatever the match is with the employer match will always be pre-tax dollars. So when it comes time to take money out down the road, you're going to have different buckets of pre-tax, Roth, match, and the Roth will already have the taxes paid on it. So those, you won't have to pay taxes on it, but it's broken down with different buckets, and it's all included in the 401k plan if your employer provides the Roth feature. So you got 401k bucket, Roth bucket, and employer match bucket.
Yep. So, when you log into your 401k account, those should be broken out for you on the websites. If they're not, again, schedule some time to discuss with your financial planner. So it's a good question too.
Yeah. The last question I see is, should I change what I'm currently contributing to my retirement plan? We definitely want to urge people to save for retirement. A rule of thumb that we consider is you want to save 15% of your gross pay, and that's between your contributions and your employer's contributions. So if you can get to around there, you're in a great spot, and you should continue to save that amount. I went over the annual limits and earlier in the presentation. If you feel comfortable, maxing out these retirement plans, that's obviously one of the best things you can do. But you do what you're comfortable doing, and the rule of thumb is 15% of gross pay.
Great, thank you everybody for asking so many questions. Gave us lots of stuff to talk about today. Again, if you have any questions about anything that we discussed here today, any strategies, please don't hesitate to reach out to us. You also have your Sentinel financial planner first and foremost for your respective retirement plans and your personal accounts as a resource, your primary resource. So please reach out to them as well. But thank you for your time today, and enjoy the upcoming weekend.